What we're doing here is we are creating a solution to that problem. We're doing co-living in Houston, Texas. In Houston, Texas, we build near the medical center, which is 106,000 employees, over 160,000 daily visitors. We have universities. Houston has a growing workforce, but they don't have affordable housing. And so that is what we are trying to do. We're trying to fix that problem, and we're doing it in Houston. Jim, if you could actually explain the types of housing that we're doing.
Yeah, co-living housing. So who here, put a one in the side chat if you're familiar with first co-living. Probably a lot of people are familiar. And number two, if you have no idea about co-living, first time hearing about it.
Someone's
Anybody
too busy.
too busy? Now, number three, if you heard of ground up co-living, because that's what we're talking about is ground up. So we're building with intent. And that's going to really change the game for any economy you build in, right? You're not converting use, you're going with a new design. So LD is you're talking about the affordability gap, right? And that's where this comes into play. Is that right?
Exactly. It's the American dream. Like, what is the American dream today?
100%. Yeah, because you're looking at okay, you have an access need for housing. You have a shortage. So when we talk about the Reeves project, before I go into it though, I love to talk about my time there on site because this is the first project that I got to visit that was finished with our team. And walking the site, honestly, I had in my mind an idea of what I was going to expect. Like, most of us we build these pictures, and when I seen the revenue numbers and I seen the construction budget, I knew it'd be nice. But I tell you what, the finishes on this property, hands down, the best rental finishes I've seen, especially for the returns that are getting paid out. So it's a unique thing. And LD, I don't know who was on this call here when you're talking about the cost going down. We were just kind of chatting a little bit before we started. But that's the thing that is always the moving target is costs. But when you're rinsing and repeating these floor plans and you're modifying the layouts just to a small degree, the same crews go. They phase it out. And with ground up, it's much easier to project out even years in advance because ground up projects, you don't have it where it's a rehab. A rehab, you have to figure it all out in real time versus ground up. You can project out multiple years and fill in as many projects as you have available to you. So this is purpose built, like we talked about. So if you can go down a little bit more in that slide. Thank you. Thanks, Lou. You got Houston. So there's a reason for Houston. And before this, I never built in Houston. But I tell you, the zoning, it doesn't exist there at all. That with the availability of manpower and resources, it's designed with intent because there's a very specific reason for Houston. LD for Houston, I've seen a lot of new construction happening in Houston. Is it that they can't build it fast enough, or is it what are your thoughts on this? Because I've seen a lot of construction, but from what I've read, they can't keep up with it.
Well, just like I mentioned in the beginning, you have the med center, you have all of these universities, and it's just the supply is not there to meet the demand. And housing keeps getting more expensive and more expensive. So, yeah, there
Mm.
is a lot of construction going on, but it's not the right construction.
Yeah, they're not building it affordable, right? It's not easy to build without reaching only a specific demographic that could afford it,
Mhm.
right? You're building it for a really small group, and a lot of people are being left out of that new build, that new home. So this changes it. The high demand rental model, number three, that's what this is. It's in such high demand because before you really get roots in the community, before you really reach your level in your career, you need a window, right, to start saving, to be able to have that affordability near areas that demand employment. So this creates that you have quality living in an area that has high job demand, and it's all brand new housing. And number four, one of the things that Dustin, you brought up to me that I didn't realize early on was how it teeter totters between the renovation model of co-living versus the ground up. So with the renovation model, you're ending up with being upside down, right? Versus
Mhm.
ground up, you have built-in equity.
Yeah, yeah, absolutely. I mean, we've done a blend, right? We've done the whole, fix and flip, buying cosmetic flips, converting them, even just buying turnkey ones. But once we saw like the way to create equity on the builds, it's really hard to go back or look at anything else.
Yeah, I mean, that's something that really attracts me to the project is when you build ground up, you're having that built-in equity with these returns, and that goes back into it. It's not just by luck; it's having the right team with having the intent to build with the right team in place results in having this financial upside and tax advantages. I mean, for that area, I'm not a CPA here, but I remember when Pace, most people who knows Pace more, we drop a one. A lot of people were recently at a meetup in California. So Pace came to the site when we were there, and he was dropping tax advantage bombs over and over and over. So there's a lot of advantages to, like right here, accelerated depreciation and how to defer taxes. So if that's an area that you're really focused on, then you definitely want to look further into that with your accountant. And
Love
then
it. Yeah.
with that, LD, I know that you yourself here are, you know, you're one that's big on saving, right? You're always the one. How do you get quality, but for the right deal with these tax advantages? Do you do that yourself? Do you have any that you do for your properties?
Oh, most definitely. Um, I don't want to bore you and go into the weeds with it, but when you own real estate, it is the most tax efficient vehicle to build generational wealth. And I
Yep,
have 8 kids, so it's very important to me.
love that.
Yeah. Yeah. We have some of our larger investors, they're only buying for tax purposes. But yeah, on this next part, I just want to say thanks for everyone. We have 170 people in here right now. Super excited to have you in here. And so far what we've discovered or discussed is why co-living is in demand. Like the money printing is abused, not just in the US, all around the world. We've also discussed different projects that we've done. A month ago, we were at filming with Pace at one of them, and that's what's really ignited our passion to just continue building these out and actually helping people in Owners Club build these out. But that's a whole other combo. So what we're discussing tonight, though, it is an investment club. We do want to highlight the total capital raise is 610. One of our primary investors, they have brought 275 already. So on fractional, we're only raising 335. There's already, I believe, 90K committed, people that snuck in there before the live call tonight. And so, yeah, that's what we're going to be highlighting the rest of this call is just some of those details. Um, so we have identified a property, an address. So there is a candidate already for this club. And I know at the end, Kyle from Fractional will explain a little bit more about how the club works. So what we're doing is we are raising the remaining capital. And so the way we structure it, it is equity partners. It's not PMLs. It's not JVs. So you are in the operating agreement with us. One major benefit to that is it helps you qualify for build loans on your own. Anyone that's tried getting a loan, you know how hard it can be in general, like just a basic DSCR. A build loan is its own animal. And so typically a lot of lenders, they want to see you have like 3 loans in the past 2 years and you built and sold or built and refied. And so you are an equity partner with us and that counts. So what we're doing is we are buying land. We've already identified for this specific club. and then we're building on it. Fortunately, the seller of the land also is our builder and potentially lender. So it's very streamlined, this project. I'm going to scroll down a little bit more. So this is a rendering. It's actually a very accurate rendering. And this is actually common build in Atlanta. And so these are duplexes. The reason on this project or this club we're doing duplexes is a variety. Like we want a diverse portfolio, even though it is in Houston still. But we want to experiment with different finishes, like beta test what people want. And so 4,100 square feet each one. This is going to be 7 beds, 7 baths on the bottom. Also on top, one main kitchen on each level. These will be uh, on the long-term debt, these are going to be 2 different loans. So part of the reason that we're experimenting with this duplex style, it is for easier refinancing. Like we can refi on our other models just fine. However, we believe we can actually push the envelope with higher refinances of the ARVs on these. And so last thing on here, I just want to mention, it is a 10,000 minimum commitment. And right around the 5-year mark, give or take, we're all going to vote. We do this vote through fractional. And we're going to say, all right, do we want to keep it and refinance, pull where the equity partners or the capital partners, you'll pull the money back out, but you'll still maintain ownership even after that. And yeah, we're real excited about it. Just since we've been building in Houston the past year, we've noticeably seen the comps, the appraisals all climbing continuously. Real quick on this slide, I just want to show some of the data. Whether you use Pat Split or not, it's basically the air DNA of the co-living world. It's a major benchmark that you should be aware of. And so a couple pieces of key info I want to highlight. 82% average occupancy. Of course, the more central you are, it does climb. Outskirts, you're going to have lower occupancy. But Houston is one of the strongest, I think it's like top 3 or top 5 strongest, most demanded co-living markets in the country right now. And so between that and then like what Jim was saying, the lack of zoning, it's just prime territory, prime market to just help serve the community better and provide affordable housing. And so LD, could you shed some light on some of the recent projects we've done? Like these are just the recent 6. I mean, we have several that we've done together and on our own, but could you just break down some of these?
Yeah, I was hoping I could actually get both you and Jim to come in here as well and explain these, but I'll start off. So I've been doing co-living. I bought my first co-living property back in 2008. So I'm very familiar with the model. We started out with, let's say, River Oak in Decatur, Georgia. We bought that turnkey, and then we moved over to Cranberry, and it was a smaller home, and we went in there and we rehabbed it. We put more bathrooms, we put more bedrooms, and that's what I've been doing for most of my life. And I've always wanted to get into new builds. And then so Reeves is actually one of the first new builds, and actually the first new build co-living that I've done. And it was just completely different, so much easier. I know Jim, he's been building big projects. Jim's more of a mentor to all of us. So we're super grateful to have him here. But he knows a lot more about scaling up and going from these rehabs to new builds. Um, Jim, if you could shed some light or give us some valuable information on that.
Well, I appreciate being here with you guys. Honored to be alongside of this amazing team. And as we walk these sites, so you see Reeves, the top right corner, that was the first one for me as well that I walked that was built with intention for co-living. And it's very unique because it could still be used for other purposes. Because who wouldn't want a bathroom in their bedroom, right? So it just creates more usability. What really impressed me is my background in construction for over 20 years. I see lots of things, right? And not all great things on job sites. But the speed to get these up was rather impressive. What right here, Drew in Houston, another one. That one has framing happening. You have Good Hope, you have Tarley. So what really excites me is the ability to continue that cycle, right? You don't have to build one and wait. You can keep stacking these up because there's so much of a need. And when I see the quality of the team that's there, it's a proven model with the intent of co-living design. You check all the boxes really. And a lot of people, they want to do ground up. I mean, I can't tell you how many times. I mean, in fact, on a side chat, if you've ever wanted to do ground up, just drop a one, because I'm curious if we have the same type of people here in this Zoom tonight. So you see a lot of people that want to do ground up, and it's nothing to be afraid of, right? A lot of people they've done remodels, they've done plenty of them, but they feel like there's this barrier to entry. You know what I'm talking about, LD? Like with
Hmm,
this,
absolutely.
like how do I go from I'm remodeling to taking dirt, and next thing you know, I have this building framed, and you don't do it alone. Like anything else, you never do it alone. You have the right team, and as we continue to do more and more of these, the team grows, right? Because there's more responsibilities on the table. But I'm excited just about the fact that we can do this and scale it and continue to offer the opportunities to more and more people in this community. It's really exciting.
Yeah, yeah, I want to highlight something real quick, Jim, that you mentioned. Is there It's a blend of like there is a challenge with the loans and then there's the mental barrier, like the mental objections, like I can't do that. I've never done new builds. And so we wanted to highlight that this is an opportunity to enter the new build world with some training wheels, some guidance. And so, like I mentioned, you are an equity partner in the operating agreement with us. So, Jim, you mentioned the team. LD, who all is on the team? We have like Ocean's 11 going on. Who all is here?
we, we have so many people. And first, I just wanted to say thank you to all of you that have come here to listen to us today, to invest with us. Thank you. Not more specific, but a great thank you to all of our investors that have invested in the past. They're investing continually. Without you guys, we could not do what we do. And it's such a great honor. And I know that people work very hard for their money and they've entrusted us with those hard earned dollars to invest and create a real estate portfolio for them. And I don't take that lightly. And so, most important for me is when you invest with us, we have a team that is put in place that can actually deliver and take the whole entire thing seriously. I mean, it's a great honor and it's a privilege to take people's money, them to believe in you. And so that's why we've assembled this team. Dustin, he has an MBA in finance. I mean, really, really smart guy. Audrey's been on the team since the beginning. She's an expert a pad split expert. She works for pad split. She's able to do all of the market data analysis before we buy these properties because we want to make sure we can fill them. Like I mentioned, Jim Vonnie, he's come onto the team a little bit later, but he's more of a mentor to all of us. I think he has more experience than any of us, and he's done bigger projects. Me, I've been doing real estate my whole entire life. We have Emily, she's a transaction coordinator. The glue that holds us together. Luke Probst, he's in here right now. He's been dealing with some family, not family issues, but his son is in the hospital, and but he's been here to help us balancing those things, which has been very difficult. So we appreciate him. He works with all of our investors. He gets all of our loans, puts everything put together. Absolutely amazing. Rhonda Chun, she's here as well. She's our finance manager. She's our CF. She's a fractional CFO with over 20 years experience. We've got Will, who he keeps everything running in the front end and the back end. Absolutely vital piece. Raquel, she's worked with me. She's from the Philippines. She's worked with me for over a decade. And then last but not least, we have Kaipo, who actually he used to live in Hawaii, but he came stateside so he could work with us and put everything together. He was able to build a big company. He grew himself out of the company. He still owns it and he's here helping us do the same thing. So that's the team. Everyone is really awesome. And once again, I just want to say I don't take it lightly when you invest with us. We make sure that your hard earned dollars, we take care of them. And it's a great honor. And I will send it back to you, Dustin.
Yeah. Yeah. And I wanted to highlight collectively as a whole, the team, over 100 conversions, developments, over 30 million assets under management. And that's a big blend of not just co-living, but regular rentals, Airbnb, small apartments. It's a very diverse crew we have here. A couple highlights on this. We are doing the 610, like I mentioned, raising that. We're already into the 300s. So about 60% raised so far. A good chunk is going towards land, like we mentioned, and then building. Like we have our own crew already identified there. And then we'll show it on another slide, but it is pretty conservative the way we underwrite this. And not just saying that, it is like on that greenhouse you guys saw a bit ago. The underwriting was done with ARV in the low 500s, and the appraisal just came in at 632. And so when we're creating these projections, it is factoring in on the low end. One of the other things that we do to just help create a buffer is on this project, we're front raising 80,000 in reserves. So just a piggy bank. And so the projected NOI, once it's stabilized, a little over 8,000. The project itself, 17.2% cash on cash. Anyone that's heard of Marcus Lemonis, he is a big fan of cash on cash. Like there's all these fancy acronyms in finance, but it just boils down to, all right, how much money is the project going to spit out? I guess not in addition to helping people, of course, but when you're looking at this as a potential investment, it's like, all right, get rid of all these weird like leveraged IRRs, all these things. What is the cash on cash? And so that's the project itself. And then broken down to the partner, the investor, that is 8% projected. Total ROI, so that's the cash flow, the appreciation because you're in the LLC with us. Some people have the tax benefits, and then the debt pay down. It's 20% projected. And I won't dive too much into this. You could always look at this on your own. But all these projections are after, we're factoring in vacancy, maintenance, property management, fractional fees, pad split fees, and then that's how all of this is derived. Again, this is on Fractional, so you can check it out on your own sometime. But last thing I want to mention on here is Rhonda. She'll be doing the distributions for this on a quarterly basis. And so those that are on Fractional, you'll see everything on there. We have 120 capital partners currently, and we communicate through Fractional for the distributions, K1s, and voting as well. So Jim, could you just give a quick rundown in different verbiage of what I just described here? I think he's
Jim,
on
you're
mute.
you're muted.
There we go.
I must hit the mute button. Thank you. So this is where you look at cash investment side. You as an investor, what you're going to expect. So if you're going to put 10K into a deal, and there's all different levels, some do more than that going in. There's a lot of repeat investors after they get warmed up to things, and some just dive right in with larger amounts. But this is an example of 10K. So if you look at year one, it's 20% estimated for your ROI. And again, I know Dustin mentioned numbers. There's all different ways and formulas that you could figure out what's the return on my dollar here, right? And how is that going to come back to me? So at every stage of this timeline is going to give you different phase of how your money will come back in different forms. So in year 2 to 4, you're going to have a cash on cash return. You can see about 8%. So you got your tax benefits, you have your appreciation. So when you add all of it up, it really strengthens your investment further. And then on year 5, you look at the cash flow that's coming in. And also the one really exciting thing for me is that everybody has a seat at the table. So everybody gets to vote. And you're not a bystander here. You have a voice in a deal, and it really makes a big difference when you're investing. Is that your vote counts. And when you go to the risks and mitigation, I mean, I live in this space. So another thing that I do a lot is owner representation, and there's a lot of risk that you have to in any investment. It's how do you reduce the risk down further? And these are all the ways that we take into account how to protect your dollars. I know LD, you mentioned it before too about, you want to protect the money. You want to make sure that the investor is well taken care of. And we do appreciate every dollar that comes in, whether it's 10K or 100K. Everybody's an equal part of coming into the deal as far as importance to us. So the market demand, that's a big one. I'm going to actually go to my own screen here to see a little better. So you have, Dustin, you say the medical center. Every time I talk about this, I get excited about the population growth. So there's a brand new medical center, right? It's been
Yeah,
growing.
it's the largest in the country, Texas Medical Center.
Incredible. So that's a really big reason why you're here. And as I mentioned, the boxes, you start checking off all these boxes of why Houston, right? And that's another big reason. And then with construction and execution risk, that's a big part of why I'm here is to help catch those things ahead of time. We were talking just today about slippage. So when you have a ground up project, you have certain milestones that you have to hit. And if you have the proper foresight to plan properly, you can alleviate that. But when you see something slipping, if you know what you're looking at, you catch it and you reroute back on course. And that's where the experience matters here. So you really reduce your risk a lot in that category. Then you have the 80K reserve fund. That's huge. Dustin, you were touching on this earlier. You're a numbers guy. Can you tell me about that a little bit more? Because that reserve fund, I don't hear about that often.
Yeah. Yeah. So we always front raise at least like 6 to 10 months of reserves. Just anything can happen, right? And so that's the first big safety net that it dilutes the returns, right? Like it makes the ROI, all of it look lower by building that in. But to us, it's worth it, right? So it's like between that and then the LTV at 63%, DSCR, like the brokers and lenders, they always tell you 75, 80% LTV. Well, that we underwrite it at 63%, and it we could make the returns look a lot higher if we didn't do that, but we don't. Just so there's another massive safety net. And then the third, in my opinions, is it's hard to underwrite it at this, but we still do it. The people that have seen our 1010s, those are appraising at 263 per square foot. This project, all the underwriting, it is using the lowest comps we can find at 200 per square foot. And so that's about a little over 500,000 in equity that we're conservatively doing this underwriting at. So instead of 2.1 million, the ARV, we're using 1.6 roughly.
That's a big swing, very conservative. And it's attractive at many levels. Who gets excited about that? Drop a one in the side chat if that's exciting for you, because that gets me excited when you see how well protected a investment is. And the last piece of this is the operational risk. So there's on-site property management, right? Well, in the area, property management that they're always visiting the site. Then you have the layout in the systems. That's a big factor because when you design properly, that's how you build in the efficiencies of the build cost. So you'll see that as you're invested with us, as you're visiting the sites, because we bring people to the site, you can see how it's efficient with the layout, the floor plan, and it's all the overall MEPs, all the build mechanicals. Let's talk about the equity club. So as Dustin mentioned, this is a equity club, and there's a few things you want to do. Soon here, you're going to have an opportunity to understand the proper steps to get involved here and to commit an investment. But it starts with a 3% fee to secure your spot. So as you can see, there is 90K already put up on the second half of the raise. and 3% is your part to commit. And then you're going to see the next thing is there's a property identified, right? Julia Street is another example. That's how you'll see an example of the address. So here's an example of here's the property. You have to vote on what's going to happen. Dustin, how does that work with the voting? I know it's surprising to me that you're allowing every investor to cast. That's every time you do the same thing?
Yeah, and it's part of the SEC compliance as well. Like you're not a limited like passive partner, like you are in the deal with us. And so Fractional, they're amazing. They help us streamline this. So the votes, they are based on equity. So if you're a larger partner, then your vote is going to have a much larger influence on the outcome.
That's great. And I see here that the LLC creation, that's handled all by Fractional, right? They handle all the paperwork. They make sure everything's in compliance, issuing the K-1s, make sure tax reporting is done properly. That's a big weight taken off everybody, is that you have a whole team behind that. And what I love
Yeah.
is your weekly calls. So you're doing this every week and it's open for all the investors to come in.
Yeah, it's a bonus. We do. So a lot of people have probably heard our like Tuesday open office hours. Anyone on the internet can jump in wide range of discussions, all you can think. But Thursday, like I mentioned a bit ago, we have 120 capital partners before this deal. But Thursday, we host a private Zoom where earlier we're diving into some of the other new builds, looking at the schedule of values, the how the draws are paid, like much higher level, much more in depth, what's going on the project. And then also we'll look at properties that they're debating, uh, how they can tackle new builds on their own or fix and flips, all the above.
So good. Well, I know you have bonuses to talk about. So if that's time for that, this is a fun part is all the bonuses based on your tier. That's up to you, Dustin.
Yes. All right. So this honestly is my favorite part. In a minute or two, I'm going to bring in one of our favorite investors, actually, one of our good partners. She's gone to the mastermind with us. And so what is the mastermind? Well, we have a variety of partners. We have people that come in at 60K, 10K. We have some, believe it or not, over 500K. And there's nothing that we sell per se. We give incentives for the higher levels. And so this first tier, we had an awesome one last year. The people that are 60K and above, we invite to Hawaii with us. You're still responsible for your own travel and all that, but this creates a massive filter because a lot of people they want to find others that are doing co-living and collaborate and be in that room. And so let's see, Luke, could you bring Fran up real quick? So Fran, if you don't know her, you need to. She is a go-getter. She went to Hawaii with us last year, found some amazing business partners, action takers. She's on the Thursday calls with us all the time. So, Fran, I'm gonna unmute you. Could you just give us some insight? Like what was your takeaway from that Hawaii trip last year?
The biggest thing really was exactly what you just said was the people, because I was able to build a partnership with these other ladies that were there that are all part of the mastermind. And we're still working together today. We're called the Powerhouse, and we're working to create our own co-living. And we have this whole team behind us to support us. I mean, text message to call, whatever you need, it's not just where you're in and you're gone, right? You have this huge, all these amazing faces you see here to support you in whatever you want to do. It's really great. And that it's in Hawaii is a huge bonus.
Yeah, thank you, Fran. So her info's in her Zoom box. If you don't know her, make sure you do. She's in co-living. She's taken action in RV parks as well. So yeah, the first tier invite to that. The second part, we are creating I'm not going to dive into it here too much, but a pod program. And it's like I mentioned, we have over 100 partners. We're going to start grouping them together and helping them, create teams and tackle projects faster together. We do a variety, I guess, probably once a month this year. We might be going to Houston at least every 2 months. And so you are this tier one level, you are invited to those trips with us. We're going to be interviewing contractors, not just looking at this property, but all of our properties, a real submersion, not just with us, but the other partners and helping you find and create your tribe. A couple other parts, I'm going to graze over this. You could always look at it more on fractional on your own. But the partners that are over 150 and above, you get all that was mentioned, but a couple other perks. An extra day early in Hawaii. So our whole team goes out there. We have all the people above that you saw, and probably 20 partners that'll be going with us in the fall, maybe 25. And so you'll be able to ask us questions like, all right, LD, how did you retire at 31? Kaibo, how did you build a business and scale out of it entirely where you only do one meeting a week on Fridays? Like how do you do that? Rhonda, how do you handle all these books? Um, or Will, like how do you run all the marketing? And so our whole team, I can't name them all and all their benefits, but everyone contributes massively, and those are the people you can be out there asking questions. So lastly, these two. We do have partners that they're in the stage of life or business where they are purely buying for tax benefits. So there are situations where we will give the bonus depreciation from our side, the sweat equity side, to them. Now, they have to qualify, you need rep status, all that stuff, but 250 and above, we can definitely talk. And then lastly, the partners that we are 500K and above, uh, we'll definitely sit down and identify, all right, what type of portfolio do we want to build together? Like, how do we want to navigate this? Especially if we have more data like their tax plan, the next 6 months, 12 months, 2 years, we can really dial in a win-win situation. And again, this will be on fractional if you want to look more into it. LD, what are we doing? What's going on?
Well, I'm sorry, I get really excited and I talk fast and I move my hands. I'm trying to slow myself down. But thank you guys so much. It's once again, like I can't thank all of our investors enough. You make it so we can do what we enjoy doing. Uh, Walt Disney said, do something so well that people will pay to see you do it, and do it so well even further that they will continue coming back and they will invite their friends to come and watch you do what you do. That's what we're trying to do here. We want to give so much value that we can go into Houston and we can put a big dent in what this housing crisis is and make money while we're doing it. Um, if you could go back into the chat, everybody, I want to ask four different questions. Now, if you were here because you're trying to build legacy wealth for your family, maybe you're at that point in your life when you're looking for giving money to your children and your grandchildren. If that's you, put legacy. If you are here because you want to invest and you want to help the community solve a problem, type in community. If you're looking for cash flow, and this is people that are early stages in their life or mid stages, they have families, they need to take care of their family. Cash flow is very important. And if you're here because you want to build your resume so you can, like Dustin said, like Jim said, you're on the project with us. When you complete these, you will literally be able to go and get loans yourself to break out on your own. And Dustin mentioned that we are connecting investors together so that they can do that. So those are the four things: legacy, community, cash flow, and resume. And I've been watching these come through. I think most people are here for legacy, a lot of people community. There's everyone's here for different reasons. And the nice thing about real estate, I'll tell you a quick story and then I'm going to ask you guys to invest with us. I had a friend who was very jealous at a point in my life when I was younger and I was doing very, very well. I was nearing retirement, like Dustin mentioned, around age 31. And he came up to me and he said, LD, real estate is not sexy. It's okay. But if you go into my venture with me, like it's going to be cool. And I don't know. I would beg to differ. Real estate is sexy. These are the things you can build a legacy, you can help your community, you can make cash flow, you can build a resume. It's one of the best opportunities that is out there. And um, I want you guys to invest with us because if you don't, we're not going to be able to make the impact as quickly that we're trying to make in the community. Uh, if I'm going to bring Kyle is with Fractional. A couple people in the comment section were asking, "What is Fractional?" Could someone bring Kyle here, and he
Yep,
will walk you through.
Kyle, I added you as co-host.
Thank you, Dustin. Thank you, LD. Thank you, Jim. Thank you, Luke. Thank you, Will. Thank you, Emily. Oh my gosh, there's so many team members. Kaipo, thank you as well. Let me go ahead and share my screen real quick. In following tradition, throw a 1 in the chat if you're familiar with Fractional. Throw a 2 in the chat if you are first time hearing about Fractional. Okay, great. We got a little bit of a mix. And you can see my screen now, yes? Great, okay. So hi everybody, my name is Kyle Brennan. I'm the Director of Investments here at Fractional. And just to kind of start, Fractional is a platform that facilitates investment clubs, and we'll dive into that now. So the 2828 Co-Living Development Club is the team's investment club. And the thing to know about investment clubs is you are committing funds to a criteria. Think of it as a business plan. Once you've committed the funds to the business plan, it is the team's job to source deals that match the business plan. And then you as a club get to review that information and then vote on it. Now with an approval vote, you will then launch into this endeavor. So with this investment club, you are an active participant. You get to co-own this co-living unit with the team. So, excuse me, you can click into the slides that were just presented here. This is the criteria. They've got a first potential deal. And then how this opportunity works, I'm going to narrate this as we go, and then I'll talk about Fractional a little bit more. So once you've decided you want to commit, come on over here to the blue button. And this is the first screen that pops up. If you are new to Fractional, it'll look a little bit more like this. So the first thing you must do is you must verify your personal name, your personal date of birth, and your social. We need to verify you as a human being because you're going to be a co-owner in an LLC with other human beings. So we just need to make sure you are who you say you are. Once you're verified as a person, then you can come down and you can set up investment accounts. So you can set up a company with an EIN, a checkbook IRA, or even a self-directed IRA with a custodian or 401ks and investment vehicles like that. Once those are added, these investor accounts will appear here. So I'm going to go ahead and select my business and move to the next screen. The minimum on this investment is $10,000, but it is not the maximum, and it doesn't have to be a multiple of 10,000. It could be 243,000 as an example, okay? Just anything above 10,000. Let's keep it at 10 as the example. So to lock in my spot of $10,000, I will pay a 3% lock-in fee. So $300. If this changes, the 3% changes as well. So I'm paying this 3% fee to lock in my $10,000 investment. And once we're in the closing process, that's when my full $10,000 is due. So 3% today, and then the full investment when we get to the closing stage. To make my 3% fee, transaction fee, lock-in fee, I can use that, pay that via credit card or bank account. And then once you've entered that information, just make sure you're checking this checkbox. Checkbox is just confirming you understand this is a lock-in fee. It is non-refundable. That is because we want you to have skin in the game. We want to make sure that when the team goes to close, your funds are there. So we need you to really think about this before you commit. once you've paid the lock-in fee, your investment will be contributed. Look at that, $100,000. Somebody just invested 10,000. So once you are a committed member of the club, you get to vote on things. And that's what's really cool about investment clubs. You have a voice, you are an active participant. Right now, those votes are listed here at the bottom. And these are things like where the LLC will be created, how you're going to vote as an LLC, that you're going to actively participate, and most importantly, that you reviewed the due diligence materials and are approving the club to move forward with this first potential deal of the team members presented tonight. The last thing I want to talk about is what Fractional does. So let's say that, you're already at 100K from 5 participants. Let's say you get up to 15 investors. Fractional will create an LLC that those 15 investors are the members and co-owners of, and that LLC is the club. Okay, so Fractional will stay on to do the compliance and taxes for that LLC. We'll do disbursements of cash flow, principal when you refinance or sell. We will do K1s for all of the investors, and we'll also be that neutral third-party manager just to kind of facilitate the relationship in the LLC. Lastly, you will have your own private community here on Fractional, and that is where you'll come together as a team to review the progress of your deal, look at the P&Ls, review who's moving in, who's moving out, and have that active participation in owning your assets. Usually there's a lot of questions. I'm happy to stick around. I will kick it back over to the team, and we'll talk soon.
Yeah, thank you,
Thank
Kyle.
you. Thank you, Kyle. Hey, really quickly, if this is where I always get a little bit tripped up. Luke, if you could please put in the chat the link for Fractional, because I know a lot of people get in here, they go, "Oh, that's interesting," but I'm clicking on the Zoom and I can't find my way there. Thank
Yeah,
you.
perfect.
Got a couple on there.
Awesome. Yeah, and I saw there's some questions about checkbook IRA. I'd say probably 20% of our partners are using different IRAs, so it is doable. I don't remember whose name it was that passed by.
Custodian IRAs, checkbook IRAs are the easiest. You just enter information as like a LLC number in your account number.
Love it. Yeah. Yeah. And so we are sharing that the club link in there, and then also we're going to be sharing questions. We saw a bunch of questions flying through the chat, and it's easy to miss them. So I'm going to put that link in here real quick. But I saw one question. They're asking, why do we not just do 28 studios? Well, a couple different reasons, but I'd say the top one, it's the risk profile. And so by doing the duplex, the debt's easier, but also worst case scenario, like we can always revert to just true duplex style long-term rentals. Whenever they're calculating the DSCR ratio, they are looking at long-term rents. And so worst case scenario is this thing breaks even as regular rentals. Even that though is that is the worst. And so with that 63% LTV and that conservative ARV, there is still realistically room for cash flow in that scenario too. All right. And then Will, could you drop the link again for the questions? And then we'll just chip away at them. Awesome. Yeah, and while those come in, yeah, we wanted to mention the reason that we came in with the 275 so we're doing 610 as a total raise, right? So the 275 is one of our main partners. They need the tax benefits. And we modeled that tier 4. We modeled this whole deal around that situation, that scenario. So we started with them and we're like, hey, do you want to do this deal? And then went from there. Awesome. There we go.
So Dustin, how much from the very beginning of the raise, the 600,000, what percentage have we raised so far?
It's a little over 60 something percent. And so the plan, the goal, the idea is we timed it around leading in the Squad Up Summit. We always like to do a raise going into one of those big events. And then also starting April, we're going to be teaching the next co-living semester. So I don't know when the next project will be because we're going to laser focus on it. Our coach, our mentor, we're going to give it all we got on that semester. So guys, we don't know when the next project is after this. In the fall, we took a little break, and so we do it in rotations. And so Carlos, on this deal, not to make, I don't want to dive into the weeds on this. Technically, we're buying the land and selling a portion of it. And so almost 200K is going into the deal. But for simplicity's sake, I don't have it on there. How many total investors? All right, I'm looking at both the chat and the site. Yeah, all right, so how many total investors? Our last one was only 14. We raised 500,000. We've done 6 raises on fractional. We do some off fractional, but I'd say price 70 to 80% on fractional. Gilbert. So all this is in Houston. Yeah. Part of it, Gilbert, is just economies of scale, but also our network, like dialing in higher quality partners, contractors, property managers, like all that you could think of. But also the comps, like the appraisals that come in, we can leverage each one because the portfolio is so close. All right, what is the lock-in period? So Jasmine, we do a vote at 5 years. And so we'll do this vote through fractional. And I'm definitely biased towards a refi, but the majority vote, if we want to sell, we could sell. But let's say we do refi. You receive your principal back out if we're able to refi at that time. And then what's cool is though you still own it. You still get the equity long term. Let's say we own this thing 20 years. Even after the refi though, you got your money back. You still have that equity play and then the cash flow all along the way. And then I actually wanted to show if someone can watch the questions, I'm going to bring up, where is it? I'm going to bring up the photos that we prepped. All right, so these photos are from a couple different models, 2 different examples actually. And so I'm a very visual person. And so we prep this to identify like, all right, what am I putting $50,000 into? What is this thing that we're talking about? And so Jim, you've built, the reality is the projects you built, these are like tiny in comparison. These duplexes that we're doing. What
Yeah.
sticks out to you in terms of like quality or in general,
Mhm.
like
Well,
what catches
we've
your eye?
we've built like when I first look at these like long corridors, I think of assisted care buildings as far as the layout. But then I look at the luxuries properties that we've done, and it's like a hybrid. Like you have these apartment complexes almost, right? They're luxury finished. I've not seen it before. So when I look at the pictures, it's different because you figure like they're photoshopped and they're at the right angle and all these things. So when I was going to the property, again, I'm expecting a good quality, but my job is to be hyper aware of all the finer details on in construction. So I mean, LD, I think you saw me and Dustin. I'm walking around like I'm an inspector because it just naturally comes to me, and I'm looking at the different angles of the trim, and I'm looking to how the doors close, and I get into all those details, and they really put out a good product. And when you look at these, you have a budget friendly price. Usually you get budget friendly finishes, but that's not the case. These are actual photos, and the quality of finishes for me, if I'm someone looking to share housing and have affordable environment, there's nothing like this, right? You're going to be willing to give away a lot, in my opinion, when you're sharing housing for an affordable rate, but you don't have to do that here. For example, the cabinets. So I've done construction for a long time. There's much cheaper cabinets available, and there's much cheaper of really all the finishes. But it's not about getting the lowest price because we're looking at durability, we're looking at the quality of living, and we're looking at the long-term investment. So if you go really cheap, and I'm on these, the last one that I was a real large project, it was in Bozeman, Montana, 16 complexes, 16 buildings, I'm sorry, in the complex, 320 doors. And they, to me, a few years after they're done, they're going to start falling apart. They're built that low budget, but these things are built to last. And I like that they're not those massive complexes because you can control the build a lot easier, right? So
Yeah,
you have the controllability.
yeah, absolutely. On this photo, I love the simplicity, but look how big that bed is. A lot of the co-living that we see, like people trying to convert deals, especially, they're trying to like cram 10 rooms, yeah, 10 rooms in like 2,000 square feet, where you definitely could not fit a bed in like that. And so what I'm pointing out is this is a very comfortably sized product that we're creating. And so the turn, like the turnover, it's a lot more favorable. Higher quality of life for them, less wear and tear, like less all of it for us. And so these are high quality rooms.
If you see in the chat, someone just said cheap amenities means less than quality tenants.
Mhm.
And that is so true. We're really trying to build something that will last and will attract good tenants. And everyone on our team, we're all taking equity in these. This is our future. This is our legacy as well. We're not doing anything that anyone else wouldn't. We're not doing anything that we're not asking other people to do. And I'm gonna stay in these projects, these builds, have my equity that I want to pass down to my children. So build quality is very, very important to me.
Yeah, yeah, absolutely. So Kevin asks, do you know when it's due to close, ballpark? Yeah, so Kevin, typically we'll do a call like this, like leading into it, we had about 100K. Typically another 100K will jump, 100, will jump on the call or within the next 12 to 24 hours. And then I'm guessing this time next week, the club is filled, especially since we get to meet a lot of the partners in person, if not before. Um, Typically on these, when we already have 60% funded, it's that whole social psychology. No one wants to be the first, right? Um, there's only a third left on this, and that's the easiest part of the raise. So it'll be fast.
Yeah, we just got another investor that came in. So whoever that was, thank you very much.
So Sherry asks, if this is located outside or inside the loop? Ooh, amazing question. Kaipo answered it some as well. So Sherry, we picked this because it's within walking distance of the red line. It sounds like you're familiar with the area. It's maybe a 6-minute walk to the metro. And that's what really caught our eye. Like you hear about bus stops, right? You got to be the pad split co-living. They're like, all right, always be close to a bus stop. Well, we found the next thing better. It's the metro. Every what, LD, it's every 8 minutes, something like that.
Yeah, roughly
It's
every 8 minutes the train goes by per
mhm.
direction. So it's very efficient. It's also right next to a community college, and then also walking distance less than 10 minutes from a supersized Walmart. So it's right in an area where people can actually live and walk. And I did see in the chat people were asking about parking spaces as well. So we are designing the layout right now for the property, and we are going to be able to, the way it's set up right now, we are going to be able to have sufficient enough parking to make it so nobody has any issues getting in or out.
Yeah, yeah. Let me see. I just took the screen share just so I could check the Q&A form as well. Someone asked, how is it structured, the LLC? So on this one, typically we'll open LLC and then the fractional LLC is in it. And that's what helps hold title. And we do that for simplicity in case alterations need to be made to the LLC. Like fractional help all that, like amending. And we found over time is much more simple that way. Do you market the property to potential tenants like the college or the hospital? So Bob, we'll use pad split, but that's where Will and Rocky come into play. Will, he already has a very successful e-com business. And so we're creating tailored ads, in addition to like Facebook ads, stuff like that, where we'll use our own QR code and it can skip that whole 10-day fee that if pad split fills it, they take the first 10 days. All right, what are the annual fees investors will have to pay? Amazing question. So Tari, there's no like it's not like private equity, none of that, where there's this ongoing fee. Um, like we are incentivized by the performance of the property. And so it is the cash flow that's how we're profiting. Like in the long run, it's we want it to perform just as well as you. And then yeah, Bob, to hit the other part of your question, we will we'll definitely connect with the hospitals a little bit, like bulletin boards, stuff like that. The property managers, they'll go above and beyond, like at a minimum, like the QR codes, and then targeted K1s, accounting. So Rhonda handles all that. Rhonda and Fractional. So as the project undergoes, different costs come in. Rhonda is submitting the financials inside of Fractional, and then you can see all of it. Like I go into my wallet or my portfolio, and I could see everything just like you. Um, the revenue, the costs, like all of it. And then they do pump out the K1s as well. All right. What man, this chat's flying. Okay, how do you manage tenant turnover and conflicts in co-living properties? So India, that's one big reason we don't have a lot of shared living. So in undergrad, I lived in 5 different co-living properties, even in different countries. And there's a phrase that I really like. I heard from a pad split rep. There's nothing good that happens on couches. And so we just have the kitchen and that's it. And then since, you have the main kitchen and then small mini fridges, and it really alleviates a lot of that tension that can build. We wouldn't call this build luxury. It's not, it's clearly not standard, right? It's decent quality. You have your own bathroom. Um, but it's premium. And so that filter, that price filter, we're filtering people out naturally just based on, that extra layer. All right, I'm just trying to keep up with these questions.
Here's one, Dustin. How much vacancy did you plan for in the underwriting?
15%. And so a good buffer. Um, I was looking at our portfolio this morning. We're at 97% occupancy is the average. So I know there's a trend right now of like, do we go with pad split? Do we not? Well, we just look at the data and our portfolio is extremely healthy with pad split. So I underwrote it with 15% vacancy. But our portfolio does not show that. It's much better.
Another
All right.
question is, what's the average projected room rates?
Oh, another good question. So we put 265. In Houston, though, we are in our properties, our rooms there, it's like 280, 285. So what are your rates minus charging? Oh, self-directed. Okay, Kyle got those questions. Perfect. Then Fran, yeah, you used when you jumped in the project, I think you used the self-directed, didn't you? Okay, how do you market quality tenants continually? So we outsource the property management, um, and they do a pretty solid job because we do a few different things with the property manager. We have different builders, different contractors, but one of them, they also manage the properties for us. We pay them the property management, and it's a win-win. They're incentivized. Otherwise, we're just not going to work with them. And so we make it clear, like, hey, these are our goals, these are our objectives. They see the underwriting and all that. Yeah, Chad, 285 per week. What kind of rent premium? are you seeing compared to traditional? Well, India, a lot of them, they have shared baths. And so like back, actually, I'll just pull it up. Back on that PowerPoint, it shows the different weekly. Let me get it. So it shows, there it is. I'm gonna screen share real quick. The comparison. So 175 for shared. And that's probably a renovated. It's not like new finishes usually, maybe a little like a new paint or something. And then 258, this is typically going to be a conversion where there's one or two rooms that are converted, but the house, it's 10, 20 years old. It's not a brand new build like we're seeing, so that's why we're above the average on it. Yeah, there we go. And so these are pretty solid benchmarks. It's the air DNA of co-living. All right, if everyone's name is on LLC, then is everyone's name on the loan? Ooh, good question. If so, how does that work from a qualification standpoint in the bank or with the bank? So Luke can answer this probably better than I. Um, Luke, if you want to jump in on any specific questions, you're more than
Yeah.
welcome. But yeah, here, let me bring you up.
Yeah. Hey, Tari or Terry, I'm not sure. So everyone's name, everyone that's on the LLC is not on the loan. So what we do is we utilize credit sponsors. So that one credit sponsor will actually take the guarantorship of the loan itself. Good thing is that we don't really work with banks, some actual banks. We use um, more in the private money style for the construction, our hard money loans, and then we utilize DSCRs for the long-term loans. So, and utilizing credit sponsors helps us do that. And actually, for every project that we've done so far, we've been able to use someone on our team as the credit sponsor. So it's kind of Dustin kind of went into a little bit in LD earlier of like what we have in this as well. And typically, someone from our team is the one that's actually taking on the guarantorship of that debt. And Jim actually is going to sponsor the loans on this one. So that kind of tells you, again, also what we believe in when it comes to these projects. So we're willing to put that up and take that on.
Yeah, we rotate internally the team. So that's one other, I guess, layer of skin in the game is the team will rotate build loans, DSCRs, all that. All right, how's Marisol said, how's the property management incentivized? They're paid based on the percent rent, but also the one I was discussing, they build for us as well. So it's like if they're not performing, it's going to influence how much business we do with them. Go. Thank you, Fran. Fran, we're going to see you in Kauai, right? Yeah, September. You bring your mom out again. Does the guarantor of the loan have greater voting power? Luke, could you explain how that's structured, where the guarantor of the loan, how, it's if a payment's missed or whatever, like how that triggers like their authority?
Yeah, so they don't specifically have greater voting power when it comes to the overall LLC or decision making. However, we put protections in place for the guarantor. For instance, it says in our agreement that if the mortgage was not paid for 60 days, then the guarantor has the right, to declare in writing to the team that they essentially have the right to sell the property. Um, it's pretty great when it comes to that. So a few things that we describe as the protection against that, right, is for one, like Dustin mentioned earlier, we do front load a reserve fund to make sure that that's not going to happen. And then I also like to describe it as we underwrite for a 15% vacancy, but we're at way less than that right now. As you say, we're at 97% filled, so 3% vacancy. And
We've
so the great thing about this model, the rent by the room model, is that you essentially are never going to be so vacant that you're not going to be able to make that payment. So there's safeguards that are put into place when it comes to that.
Yeah. Sherry asks, so use private property management, not pad split. So Sherry, uh, great question. It is a common misconception. So pad split, they just fill it. So it's like Airbnb doesn't manage their Airbnbs; they just fill it. So it's very, very similar. And then they have the technology side, right, where they'll, collect payments, assist with communications. And so you use pad split, and then we hire a high quality property manager. And then the third layer, actually, on our team, we have an asset manager. So there's three layers between us and the tenants. Emily, yep, we're gonna see Emily. I believe her. She says she's gonna be in Hawaii September. It's gonna be like the last 10 days, Emily, roughly. And so yeah, India, similar to Turbo Tenant. Yeah, it's just like they're dialed in on their marketing arm. Like that's their focus. It's not managing, but just getting people in front of you or your property manager, like in the house. What additional marketing do you do? Does marketing yourself help? Will, are you on here? See it. Will, if you're still on here, could you give like a brief explanation, super brief, of how we're going to expand marketing with different properties? Like if we wanted to slam the gas, how we did it?
Yeah, so the goal is to essentially target different channels like Facebook, running ads on Facebook, also some I think you alluded to it or you mentioned it earlier, which is like kind of like the job boards per se in the area in the community. So it's like just placing ourselves as a vendor and a resource for housing precisely. So by either collecting emails and then upping the list so that we can get people into the properties as we build them.
So
Perfect.
does that save us money? Is my question.
Yeah, it directly impacts how much we pay Patsplit for finding tenants themselves.
Okay. So that
Yeah, we
right there would in turn help on with the return to investors, correct?
Correct.
yeah, we skip that. So Passwell fills it, right? They take the first 10 days and then ongoing 8%. But if we fill it, they're not taking that 10 days, that first 10 days. So it's a noteworthy chunk of change. All right. Eddie says, what's the total estimate of the steel loan capital raise? And then some zoning questions. The total estimate of this capital raise, I guess they worded it weird. So we are raising the 610 total. We've already raised a little over 300, 330s, 350, something like that. Or no, almost four. We're getting close. All right. Jim or LD, how do the local zoning laws and occupancy limits affect the scalability for
Let,
living in
let,
different
let-
cities?
yeah, let me answer that. So the cool thing about Pad Split and how they're set up, it's an LLC. So that's how they're able to get around the unrelated individuals in a house. Now, anytime I can go up against the city and win them, I love that. However, the one thing that I will not do, and I've done it in the past with some of my properties, where we build we not build, but we do a conversion in a neighborhood that's not in Texas, and we take a house that used to have two cars in the garage, and now there's six cars in the garage, and the neighbors come over and they complain. That is something I've done, and I will never do that again. So this model works. It works around the country, but you really need to be careful what neighborhoods you go into. Because if you're going to go into an A class or B class neighborhood and fill the street up with cars, you're not doing anybody any favors. And that's why we are focusing on Houston, Texas. Number one, the need is there. Number two, the city wants us there. And number three, the neighborhood wants us there as well because we're in rejuvenation zone. So what we do when we go in there, we actually help the whole entire neighborhood.
Yeah,
And
yeah,
also
great
for
points.
zoning, if I can add to the zoning piece, because there's not a traditional zoning there like most major cities. So you don't have that strict red tape to deal with. And the regulation, like you mentioned, LD, they want more of this housing. So it's in favor. It's like having the proper understanding of tax codes to get your most tax deductions. You have the understanding that there's proper zoning in place to build the most amount of units. And this type of build, it fits perfectly there. So it's a really, there's a lot of reasons to go into Houston.
Yeah, yeah, absolutely. Yeah, so India, there's I didn't catch where you're at, but that's one thing I touched on briefly, like the pod licensing is our partners that we've already done deals with where there's more trust, rapport. We definitely help assist. Okay, Myrtle Beach, I think Fran, South Carolina. Um, we definitely help the partners expand. Like that's what our Thursday, like that private Zoom, the partner only Zoom is we genuinely will look at your project, your plan, and dive into it. Yeah, Brandon will definitely send out, yeah, recording.
It'll
Okay,
live in the
so
fractional page as well.
okay, yeah, I was gonna say, how do people get the recording?
Yeah, we'll post it on Fractional. It'll be emailed out. It'll be a few different, yeah, a few different ways. Have you considered other Texas metro like Dallas and Austin? Oh, I mean, we're open, but it's so good in Houston that it's like, does it make sense for us to pivot?
You know,
Maybe
and
eventually.
when Dustin says we're open, he's being polite. Really, we're not. We have something really, really good going on in Houston, and there's no reason to really go out. I mean, there's opportunities everywhere you look, and that's the wonderful thing about real estate. And it's such a big community that you can go wherever you want. But for the foreseeable future, we are completely 100% dialed in and focused in Houston, Texas.
So you took my diplomatic answer away. I was gonna say we're open, but we don't see a reason to pivot.
Yeah.
But yeah,
You say
Houston, it's hard to beat.
it's hard to beat. And Dustin always has the diplomatic way of saying things. My wife always jokes that when I open my mouth, I say really dumb things. My daughter said the same thing the other day. She goes, "Dad, when you open your mouth, you just talk and you're really not that smart." But we love Houston and we love our investors. I can't say this enough. And the people that invest with us, they know what we're about, where we're investing their money. And there's no smoke and mirrors, there's no sleight of hands. We are in Houston. That's where we're going to stay for the foreseeable future.
Yeah. So I want to show, I think we're gonna do like maybe 5 more minutes of questions and then wrap it up. Jennifer, you said, do we have a deadline of when to be fully funded? So Jennifer, I just want to show real quick a few of our projects on Fractional. I think this is number 6, right? So they fund, especially when we go into an event like Squad Up. Like we purposely timed this specific one going into Squad Up because that's the best way to raise money. It's in person. So this is the one that we did um 2 months ago when we opened that club. Funded pretty fast. You could see our other ones as well on here, River Oak, Cranberry. So this one, it's gonna fill probably, I guess it'll be fully filled no later than this time next week. Like I think we all arrive Wednesday, and so between now and then. So, do you have a GC in place that you use regularly for your ground up? So we have a few, Megan. They have different styles, different pricing, but also from a risk perspective, we're building with a couple of GCs, so we're not dependent just on one.
And there's
Awesome,
also one other
guys.
thing that I wanted to mention before we leave here tonight is when you do invest with us, I know Dustin mentioned this, but I'll mention it again. We have in office hours every Thursday. And when I first heard office hours, when we started working, I was a little bit confused. We don't have a physical location. There's Zooms for our investors across the whole entire country. When you invest, you can come every Thursday and we can have high level conversations. You can ask anything about the project, anything about projects you have going, and we're there to answer questions. And then weekly, we send updates, we send pictures of everything that's going on the project that you're invested with. And so it's very important for transparency. And I said this earlier, Walt Disney says, do something so well that people will pay you to watch you do it. And then they will come back and pay you more and they will bring their friends. And that's the idea. We take care of everyone here and you guys will continue to come back with us and invest. Like we were showing on the project, we are already, before we even opened this call tonight, we had 50% of the project already committed for. And then on the fractional page, right before we started the Zoom, there was close to $100,000. So we have really good investors, and we're going to continue to under promise and over deliver. That is my hope.
No, yeah, absolutely. So India asks, how are you controlling construction costs given Houston's volatility in labor and materials? That's a great question. We're always expanding our network there. Um, just yesterday, we found a brand new amazing contractor that we're thrilled. He's in Sub 2, he's in Gator. He's been building in Houston like 10 years. So that's the main thing is we're constantly expanding our network in Houston specifically. So like some people they'll be like, all right, I want to co-living in North Carolina, Texas, Florida, Georgia, and then their network is very superficial. It's like it's not a in-depth, it's not a deep network where you can just you have 10 contractors, 10 plumbers, like and so that's a big angle on our side is just getting to know the city very well. Uh right, so Kevin, how do you join the group? Where you join? Yeah, Kevin, I think we're gonna talk right after this, I think Luke said. And then recommended company for self-directed. Fran, which one did you like again, Fran? What was your preferred? Okay, and then oh, Maribel, thank you. You were on office hours earlier.
Wholesale piece, which is the division I
Maribel says all the fractionals she's joined, our team does the most to keep investors in the loop. Yeah, we appreciate that, Maribel. And then Jonas, go ahead, LD.
I was going to say, and one other thing, I did talk about our Thursday office hours with our partners. We also do have Tuesday, and that's for people that are not involved in any projects with us at all. I do ask that you guys please come to that if you have questions, not about our projects, but if you have questions about anything that you're doing. The idea of this is not to sell anything to anybody. It's just to give value back to everyone that has given us so much value. So please come to the Tuesdays office hours. I'm sure someone will put that in the link, and come ask questions. And it's free and it's just about giving value.
Yeah, yeah, absolutely. And then Jennifer, I recognize your name. I think you're in San Antonio. I think it is that the event happening in April. Um, we're not in Houston, but we visit it frequently. We're going sometime next month is the next trip. And then Brandon, yeah, we could definitely talk about a way to collaborate in Houston. We'd have to discuss it more. And then Eddie, is this deal classified as multifamily for tax benefits and loan? So we're looking at it from a few angles. We're technically residential. However, a month ago, we've got the first commercial appraisals on this. So I didn't even hit on that much. I should have earlier, but what's really cool is we can build at single family prices, and then we're already seeing the ARV climb as if it's small multifamily. It's like NOI, cap rate, all that fun stuff. But we are starting to see these uh, changes. So like the commercial appraisal that came in on one of our 1010s, it's at a 6.5 cap rate. And so yeah, like the whole world's starting to look at these different. And my plan is, well, I'm just hoping one day we all wake up and the lenders, our preferred lenders, tell us the whole portfolio is now valued on NOI and our net worth dramatically all jumps as partners. Because depending on what cap rate it is, like that changes six figures very easily, the ARV. Uh, Danielle, we just have one in Atlanta. Let's see. Any last questions? Yeah, Jennifer, we'll be in Texas next month. I plan on going to that event. I think it's the last week of April. All right, India says, one more question. What exit strategy are you planning for fractional investors? Refinance? So both, the first and last. Refinance, but also, keeping it. Because we do fully expect, like this is the blue ocean pace where they're trading at single family comps appraisals, but we're already starting to see like buyers and sellers agree, like, all right, we're not using a 5.3 as a comp anymore. Um, and so the ARV in just the past year, we've seen it climb well over 100,000 on this on our 1010s, which is very similar to this. Yeah, like Fran said, we're gonna all do a vote all together. Well, cool, everyone. Um, any other questions before we jump off? For the amount of room, are you to require sprinklers? No, Jonas, we do not. And then the 1010s, we have one full kitchen and then two kitchenettes. Yeah, like Jim mentioned a bit ago, the zoning in Houston is extremely favorable. When we were there, we were at one of the properties that they just broke ground on, and it was a food truck, and then a house, gas station. Like it's its own world. And then yeah,
Yes.
Megan, each one, yeah, its own laundry, like each part of the duplex. Awesome. Well, perfect. I think that's it for tonight. LD, Jim, Luke, any last things that we wanted to throw in before we jump off? This recording will go out as soon as Zoom lets us send it out.
Yeah, I just want to once again, I know I'm a broken record, but thank you guys. We can't be here doing this if it wasn't for all of our generous investors, and we will pay it forward and be good stewards of your time and your money. And we appreciate all of you guys. Thank you.
Yeah, appreciate you guys being here. I see in the side chat about Squad Up. We'll be there. LD, Dustin, you guys will be there, right? Luke, Will. So anybody go in there, definitely meet you in person next week. It would be really great to do that. Thanks for being here. It was a pleasure and honor to be able to sit here tonight for what is it now? An hour and a half. It's been awesome. Thank you guys.
Mhm. Yeah, thanks everyone. Have a good night.
Good night.
Good night, everybody.